All right, good afternoon. Um, I'm doing partnership again today, so it's just a rundown on what you need to remember for your examination. I think you can see the syllabus outline. Maybe a simple thing is to just remember the definition. What is a partnership? A partnership is a business in which two or more people work together as owners with a view of making profit. I think it's an agreement between two or more people in order to make a profit as they run the business. Then I think what you need also to know is the advantages and disadvantages of partnership business. I think we've covered this one. We are saying advantage, additional finance is available from other partners, then additional knowledge and experience, shared responsibilities and shared risk. Then disadvantages of running a partnership. Profits have to be shared among partners. It's a disadvantage. Unlike in a sole trader business, then we've got also decision making take longer to put into effect. I think that's obvious in the disagreement, so on and so on. I think that one, please remember that. Then partnership agreement. Partnership agreement is a document setting out the rules under which the partners operate in the business, including profit sharing arrangement. So a partnership agreement, partnership deed, it's a partnership agreement. So these are some of the things that I think we covered. This one, amount of capital contributed to be contributed by each member, the rate at which we are going to share the profits. Then if interest on partners' drawings is to be charged, then interest on drawings. All right. Then also if there is if interest on partners' loan is to be paid, so at what rate, then interest on loans. All right. So I think I want to measure on things that you might forget. Loan from partners. Let's say there's a partner who contributes a loan to the business. So that loan, the treatment of this loan contributed by partner is just like any other loan. The interest on loan is an expense. Then possibly let's look at this one. When a loan is obtained from a partner, obviously we debit the bank because we are receiving what? Money, then we credit the loan from the partner X account. So it means we credit the loan account, then we debit the G. What we debit the bank account. When a loan is repaid to a partner, we just do the reverse until we close. It means we pay, we credit the bank, then we close the loan account that we had created. Right? Then see also the journal entry. The loan account appears as a non-current liability in the statement of financial position. So the loan paid by the partner obtained from the partner is a loan. So it's a non-current liability. I think this one must be very clear. But look at the interest on loan paid. You debit the interest on loan account. It means it's an expense. And all expenses are debited. So we debit the interest expense account, then we credit the bank when interest is what? Is paid. Interest on loan is not yet paid. It means we still have an outstanding what? Loan interest owing. Then what do we do? The amount you credit partner's current account. So the interest on loan account is transferred to the debit side of the income statement under, it means in simple terms, we are recording it under what? Expenses. What I want you to note is this entry. Okay, remember it's just a revision, so I want you to note this one. Interest on loan due but not paid. What do? You debit the expense, which is the interest on loan account, and then it means this is an expense. Then you credit the partner's current account like this one when it's owing. Okay, so I think that's the entries that you should remember. Interest on loan account is transferred to the debit side of the income statement. It means this one is treated as what? An expense. So this one is an expense. Okay, this one is what? An expense. I think this one is clear. Okay. Let's move on. Let me check my answer. I think you got that one. So the loan is just treated like a normal loan. I think that's what you need to remember. Interest on loan from partner is an expense in the income statement. It is not an appropriation item. I think that makes sense. Let me move on to next item. Remember, it's just a recap. You just remember this one: preparation of profit and loss appropriation account of partnership. So in appropriation account, that's when they're supposed to distribute what? Profit. A partnership appropriation account is part of the year-end financial statement. It shows the division of the profit between the partners. So in appropriation account, in simple terms, we are distributing the what? The profit. And so we prepare the normal income statement, and when we get the profit for the year, what do? We then distribute using the appropriation account. So it's as usual, they give you this information. Look at this one, I'm using our textbook. Look at this one, they provide this information, the capital at the start, the drawings at the year, during the year, then profit during the year from the income statement, then they provide the interest on capital, interest on drawings, the salary, then the share of profits, the residual are shared what? In proportion of what? Capital. So what you need to do is to prepare the appropriation account. The appropriation account, we start with the profit for the year. This is the amount. Then what do? You add interest on drawings. And so we add interest on drawings, yeah, this one and this one, S and P. Then we get the total. Then we less interest on capital. This is it. We subtract interest on capital. We subtract interest on capital for another partner. Then we also subtract the what do you call it? The salary again. Then also we then share the profit. I mean, this amount we share. Are you seeing how they share the amount? Then we are done with the appropriation account. Then at times they also want you to prepare the capital account and the partners ledger accounts. My ledger accounts in my partners, they are usually two: capital accounts and current accounts. Capital accounts are prepared in the way in this way are referred to a fixed account. So we are saying usually my capital account inongoramba yakangoita sei ingori fixed. A fixed capital account. Okay, a fixed capital account, it means we want to capture the original capital that the individual contributed. And just remember, capital account is a credit what balance is the business owes owes this to the partner. Then instead a fixed capital account, and inside a fixed capital account, we want to see the original contribution by each member. And then we move on to current accounts. And current accounts now is a subdivision of a capital account. Each member of a partnership business also has a current account. Anything which a partner becomes entitled to, such as interest on capital, interest on loan, partner's salary, and profits are credited to the capital account, the current account. I think this one is an obvious thing. Let me show you. I think we covered this one as loud and clear. Then drawings, I think we need also to know that drawings account is maintained for each drawings account is maintained for each partner. Total of this account is transferred to the partner C current account at the end of the year. So we prepare our drawings account. So I want you to see this information. Then they require you to prepare a current account. Still say you prepare it 1-1 or in Colana form. 1-1 or in Colana form. So I usually prefer the one that is in Colana form. In Colana form, it means this is a current account. And tutanga nema balance here to BD. So please take care of this one. Can you remember this one? Can you remember this one? So be careful of the balance. If there is a debit balance like this one, it means this partner is insolvent. And the partner Namaro. But when the balance is like this one, it means this is a solvent partner is money. And then what are we adding? For S, we add interest on capital, we credit this one, then we credit also this one, then we credit my salaries again, then the share of profits. All this we are getting from the current account. Is it making sense? Then we debit the actual drawings, then we debit also the interest on on drawings. Then please remember to balance off and put the BDs. And there are marks for doing this, for putting this BD. Instead, the SCD is marks, but usually the BDs, they are marks for doing this one. So this is the current account on the credit side. So a current account is a subdivision of a capital account. On the debit side, we have this one is a minus, the plus this side. I think it's loud and clear. Let me Let me do this one. Let me erase this. All right, let me move on to another aspect. So we are done with the current account. So, but don't forget the capital account. The capital account is a fixed capital account. It means you want to show the original balances. Tongoma maintain a fixed capital account. If you want to balance BD on the credit side, the capital account is a credit balance. 40,000 credit side. Then we move on to current accounts. And to current accounts as usual, you know this one. Then to the preparation of statement of financial position of a partnership business. This is a very simple one. And an extract showing my capital. My capital accounts and 40,000, 20,000. Then the total is 60,000. Then my current account, be careful. And can any debit balance to it's a minus. And then can any credit balance is a plus. So this one is 5,600. The 700, this one, and it's a minus. And so you add, then you get your totals. I think you can actually see. Let me show you where they got the minus 700. It's minus 700. It's very clear. It's the debit balance. The balance we are referring to the BD. And look at this one. Look at this one. And you see this is a debit balance. This one, it means it's a minus. And the balance can help debit or current account, it's a minus. This one is a what? It's a plus. Please take note. This one is a plus because capital in current accounts. You've got a plus on the credit, and this one is a what? It's a minus. But when we are doing our SFP now, we use my closing balance. Sign the balance sheet. We are referring to the BDs. That makes sense. All right. Let me move on. At the part, I hope you are following. This is just a recap. Please get it in actual detail. So that's our section. That's why you are seeing this one is a minus. So this is 5,600 minus 700. If this was a credit balance, we are supposed to just say. All right. Let me show you how the SFP will look like. There is another format where you can show an extract of financial position. It's just the same. And you're going to 40,000. Then the opening balance, we put this opening balance. And then what do we add? Interest on capital, we are adding. Then what are we adding? We are adding interest, salaries. Then we are adding this one. Is just the same. I think we did this one inside. And then to less my drawings, to less interest on drawings, and then at less, and we still get the same answer. And you can just see that 64,900. And let me show you that we have 64,900. 64,900. So transfer my balances here. All right, let's move on. All right. So let's move on to a question, possibly how it is displayed in most cases. And let me show you. They will show you very simple things. But I want you please to remember to prepare the dates and to remember the dates and when you're preparing this one. Can you try this question and ask me any question and you on this one? I think we did this one in class. So please remember to just try this question and see how it goes. So that's partnership. Please remember the dates. January. It means 12 months. June 6 months. You calculate the interest on loan on accrual basis. And all right, I think that's fine for today. All the best, all the best, all the best, all the best. All right, let's stop from here. We see what we can.